Good afternoon, everybody, and thank you for joining us today to the AASB dialogue series on data as capital, rethinking intangibles in a digital world. So my name is Sabine Schürer. I'm a senior manager here at the AASB, and before we dive into the session, I want to go through housekeeping as usual. The dialogue series is held jointly with CPA Australia and CAANZ. And indeed, our chair today is the CPA External Reporting Lead, Ram Subramanian. And I want to highlight, hello Ram, I want to highlight that the views that are shared today are not the views of the organizations, but the presenters' personal views. And I would also like to encourage our audience to engage with us during the session and post any questions in the chat. We will try to address them either during the session or at the end of the session, depending on how we go. So as I mentioned today, the dialogue series is on data assets, and there's growing importance, a recognition of growing importance on this data. And the standard setters are also considering this important topic. So data assets are intangible assets, and as we know, intangible assets, especially internally generated intangible assets, can only be recognized under very specific circumstances as assets in the financial statements, otherwise they are expensed. And so this means really that a lot of the data that is currently internally generated is not recognized or reflected in any way in the financial statements. So Dr. Andreas Barko, the chair of the AASB, has said that the rise of self-generated intellectual property and its non-addressal is actually one of the biggest challenges that and opportunities that the AASB is facing. So the AASB is currently considering the intangible assets project, and so there is a timely opportunity for us to have this discussion. As is customary, we will start with research, and today we have two research presentations. The first research presentation is from Lina Xu, and Lina is a lecturer at the RMIT University and an award-winning researcher whose work explores accounting in regulatory and institutional contexts. Lina has published in top-tier accounting journals and won competitive research grants. And then the second research presentation will be by Dr. Junhao Liu, who is a senior lecturer in accounting at the University of Melbourne. And Junhao's research focuses on financial reporting and disclosure and accounting for intangibles, with a particular emphasis on the intersection of the digital economy and accounting practices. Junhao has also been published in high-ranking journals, and he was selected as a finalist for the US FASB Emerging Scholar Award for his work on corporate digital assets. So both research presentations will be on new Chinese regulation that allows Chinese companies to recognize data assets. And so I'm very much looking forward to hear what you have to report. So that is enough from me, and I hand over to Lina.
Thank you so much for giving me opportunity and to do presentation on my research project, Data Assetization in China, a very recent update. Well, why we should recognize data as an asset? As we know, data is increasingly considered as an engine driving the total value and growth of modern organizations. However, under current ethos, most internally generated data cannot be considered as an asset. Starting from 2022, China's state lead initiative aims to position data as a new productive factor and drive digital economic growth. So under this initiative, there are three main types of data asset: public data, commercial data, and personal data. In order to ensure the successful transition, there has established more than 50 national and regional data exchange market in order to allow for data trade. So in order to provide sufficient service, accounting firms, law firms, valuation agencies, so have been used to do the compliance valuation for data asset. Starting from 2023, Ministry of Finance in China has issued an interim provision on accounting treatment of enterprise data resources. This is a voluntary guidance. Under this guidance, data intended for internal use could be recognized as an intangible asset. The disclosure requirement is very similar as the intangible assets disclosure requirement. And secondly, data involved in external transactions could be classified as inventory. Disclosure requirement is similar as the inventory disclosure. There are other disclosure requirements. So for instance, when the value is really very significant, the disclosure should include the sources, methods, key assumptions. And also there are some optional requirements, like under what circumstance data can be used as an asset, what is the application scenarios. For today's presentation, we mainly collect our data from Wind database and the firm's annual report. So the first year for the implementation of data resources is starting from 2024. By then, there are around 100 firms recognize the data as assets. Up to now, mid-2025, around 112 firms, so which takes 2% of list firms disclose the data-related assets. As you can see, the increase is not really very significant. Which industries prefer to recognize data assets? If we look at the pie chart on the left side, the leading sector is the information and software service sector, which takes 25% of all firms, which is followed by manufacturing, takes 23%. However, on the right side, this is a distribution of industries by values. As we can see, information and software companies, they take 79% of values, and manufacturing only take 9% of values. Which business types prefer to recognize data assets? On the left side of our pie chart, as we can see, the leading firm is the private firms, which takes more than 41%, and then followed by local SOE. So they take 37.5%, and for central SOE, they only take 13.4%. However, when we look at the distribution of ownership by value, central SOE, which takes 69.5%. So private firms only take 26%. And for local SOEs, despite the number is pretty high, but the value is really very low, only take 3.6%. On the annual report, which data asset categories are more popular? So in general, firms normally put data assets under 3 categories. The first one is data as intangible assets. The second one is data as a development expenditure. And the third one is inventory. As we can see on the diagram, so more than 100 firms has put data under intangible assets. The total value is roughly around 1.6 billion Chinese yuan. Well, even though the number is really very significant, I would really like to share more insights for you. Unfortunately, organizations normally do not disclose any details in this section. They simply present the final data and final numbers for us without much explanation. So the least popular one is the inventory category. Only 2 firms has put data under inventory. When we consider total assets, how much data assets has been taken compared to total assets? Well, the total value of data assets across all firms remain really very small compared to total assets. For most of the firms, it's less than 101% in most cases. Even for leading digital firms such as China Mobile, China Telecom, and China Unicom, data-related assets only represent 0.04% to 0.06% of total assets. There are a few private IT firms show slightly higher proportion, but still remain very marginal. And there is no clear trend that suggests an increase in data value over 2 years. So on this page, we are going to use China Mobile as an example to explain how data assets has been reported. So for China Mobile, data assets takes around 0.04% of total assets. There are 2 main categories of data asset. The first one is intangible assets, which takes 454 million. If we convert to Australian dollars, it's roughly around 100 million Australian dollars. Well, unfortunately, in the financial reporting notes, there is no detail has been provided at all. So based on reading the entire annual report, my feeling is it should be from Wutong Big Data Platform, which is completed data products. It can generate a large amount of data and can bring some benefit to China Mobile, for example, analyze customers' consuming behavior. The second category of data asset is from development expenditure, which takes 320 million Chinese yuan. Well, unfortunately, there is no detail has been provided in financial reporting notes as well. But through reading company's report, it should be from ongoing data and AI platform development. Well, as I mentioned, for both data, like Wutong Big Data Platform and also AI platform development, both data are only mentioned in chairman's report, not in financial reporting notes directly explain data assets. So actually the increase of data assets has not been really increased significantly. What are the challenges? The first challenge is related to valuation. Because of data quality and also lack of a valuation system, this has caused lots of challenges for firms to disclose data as an asset. The second challenge related to existence of ownership, whether the reporting entity has legal control or usage rights. So who should manage, protect, or share data? Those 2 are the key challenges firms faced. What are the key lessons we can learn from China's experience? As we know, data is becoming a very important asset. Well, so there already emerged some different models for the organizations to recognize data as an asset outside IFRS framework. There are several key important lessons might can learn. So first of all, in China, it's a state-led initiative to recognize data as an asset. So the risk is it may prioritize public sector gains. Secondly, data asset recognition is still at a very early stage, with significant uncertainties in identification, measurement, and subsequent treatment. It might be important to build some clear guidance on recognition and measurement before the implementation. So information disclosed in financial reporting notes remain very general and limited. Even though there are optional disclosure requirements, this has provided little incentives for firms to report on data asset related issues. So thirdly, adoption remains low despite policy support in China, mainly reflect ongoing challenges in valuation and ownership. Overall, so there should be a stronger integration of accounting standard to ensure global consistency. And also China's experience also offers some insights for IASB's ongoing intangible assets project. And there are suggested readings and references. So thank you so much.
Thank you very much, Lena. That was a very interesting presentation. I already have so many questions, but I will leave them to the panel to discuss later and ask later. So now, Junhao, if I hand over to you, please.
Thanks. Nina, could you please stop sharing so that I can share the screen?
Oh, I already stopped. Oh, sorry. Okay. Oh, good.
Okay, thank you. Okay. 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 Good afternoon, everyone. My name is Jun Hao, and I'm a senior lecturer in accounting at the University of Melbourne. First of all, I would like to thank the AASB for inviting me to the dialogue series and the opportunity to share my research here with you guys. I was just thanking Nina for the wonderful presentation, and my research is kind of complement to what Nina and her co-authors have done. The research paper I'm sharing today is titled Accounting for Data Assets. It's on the recent accounting standard update in China that allows firms to recognize data resources as assets. The project is co-authored with Xin Chao and Hai from University of Toronto, and we use surveys and empirical analysis to figure out how firms perceive and respond to this new accounting rule for data assets in China. So first, I would like to talk a little bit about the motivation of our study. So our paper is broadly motivated by the claim that accounting is losing its relevance due to non-recognition of intangibles. And one reason identified by researchers and practitioners is the non-recognition of intangibles. This is because we're now in a knowledge-based economy, and intangibles are becoming more and more important in value creation, whereas they are not recognized as assets under existing accounting frameworks. And one natural remedy to this situation is to recognize intangibles, especially internally generated intangibles. This is the solution proposed by the researchers and practitioners. However, it is unclear if and whether this solution would be effective. We do not have enough information about whether firms, as the suppliers of financial information, would be happy to do recognition. We also do not know if investors, as well as other stakeholders, as the consumers of financial information, would find the information useful to them. So there is very limited real-world evidence on this topic because we have not had substantial changes in accounting standards for intangibles for a long time. In particular, there's no accounting standard addressing the reporting of intangibles in the knowledge-based economy. So our research is trying to fill this void by examining the pilot accounting rule in China. The new rule was effective since January 1st, 2024, and it allows firms to recognize eligible data resources as well as other intangible assets or inventory on balance sheet. It also encourages firms to provide more voluntary disclosure regarding data resources. And there are several goals of our study. We first assess companies' perceptions and responses. By doing so, we are able to evaluate the feasibility of recognizing data resources. And in the meantime, we identify key challenges in implementing and complying with the data asset accounting standard. With all of our analysis and evidence, we aim to inform accounting standard setting for data resources and more generally intangibles in other jurisdictions like Australia and or other countries. To achieve our goal, we use 2 rounds of surveys together with archival data to evaluate firms' perceptions and responses to inform of our discussions on this accounting standard update. So first, I would like to talk a little bit about the background, I think Nina has done a great job explaining what's going on here in China. So the accounting treatment for eligible data resources, there are 4 different things. The first is eligibility. It only considers whether future economic benefits are expected to belong to the firm. And the recognition separates data for internal uses and external uses as either intangible assets or inventories. And as for measurement, right now the accounting standard says the measurement must be based on historic cost, either transaction price, acquisition cost, or internal generated. They count all the expenditures associated with generating the data resources. And after recognition, there will be, excuse me, there will be impairment tests and monetization going on. Okay, and on top of that, the regulation also encourage firms to provide voluntary disclosure of data resources to ensure it is informative and meets the demand from the stakeholders. And here are a few unique things of data resources that attracts our attention. For accountants, I think the 2 main things here that poses challenges to recognition is property rights and measurement and valuation. So the property rights of data is very unique. The ownership of data, first of all, lacks a clear legal definition and protection. And also the ownership and the access rights or the user rights are oftentimes separated. So the owner cannot really exclude some users from using the data once the user have access to the data. And in addition, we also have positive economic externality of data. And this is also something very challenging to distinguish the property rights of data. And in addition, the measurement is also a problem. Historic costs could largely underestimate the value of the data, and also for fair value, we do not have very good measures because it either requires market prices or reliable estimates of future economic benefits. But these things are not readily available right now. And the value of data is also state dependent. So it varies across different scenarios. Okay, so now I kind of like summarize the findings from our archival data. So consistent with what Nina just presented, roughly 2% of firms have recognized data as assets. They tend to be larger firms, and also they tend to be firms with high leverage and low ROA, suggesting that they have stronger incentives to recognize data resources to improve their financial statements. And also, we find that state-owned enterprises are more likely to do recognition, probably because of political pressure. And even though we have only limited number of firms doing the recognition, we find signs of earnings manipulation because we notice that some firms are using recognition of data resources as an opportunity to improve their earnings because that has substantial impact on their SG&A expenses and earnings. And overall, we asked a question, why is recognition of intangibles not well received by companies? And we did a survey to all the public companies in China, more than 5,000 companies. And we had 2 rounds, one right after the initiation of the new accounting standard and one after the first annual report. And here's the overview of the findings. So on one hand, firms perceive data resources to be very important for their value creation and business activities, but they still refrain from recognizing them on the balance sheet because they think the cost of recognition outweigh benefits and the perceived benefits are declining over time. And also, they refuse or they tend not to provide qualitative voluntary disclosure in their MD&A section or financial statement footnote. So yeah, that means not all of them are providing detailed explanations for their data resources. And the major reasons for the hesitance is threefold. First is regulatory ambiguity, and the second is the compliance cost, and third is because of the unique characteristics and challenges of recognizing data resources. And let me just quickly run through some of the most important results from our survey. So the first piece of the evidence shows that data resources are very important as perceived by the firms. Most firms agree data are very important, and they think data resources could consist of like more than 10% of their total assets. And in terms of the perceived benefits, most firms, they kind of agree with the benefits, but over time from 24 to 25, their perception is declining, possibly because they are aware of the challenges of recognizing data assets right now. And in the meantime, the perceived cost is increasing. So there are many types of costs, including the cost for infrastructure and human capital, direct costs for reporting, auditing, litigation risk, and proprietary costs. And here's the reason for non-recognition. And the most prominent reason is the lack of clarity in the regulatory explanation. And also firms find it's difficult to clarify the property rights, and they also worried about the risk of recognition and disclosure of data resources. And we also asked them whether they have plans to comply with the new accounting standard in fiscal year 2025. And most of them said no. And they also said that they are not going to provide additional disclosure on this regard. So based on what we have right now, it seems that this accounting standard is not really well received by the companies in China as the suppliers of financial information. So here are the takeaways. So we use survey-based and empirical evidence to assess firms' perceptions. And this will help us to understand whether it is feasible to push forward this kind of regulation for reporting for data asset and recognition of other intangibles. And this could speak to both the recognition of data resources and help us to understand the recognition of intangibles in general. That's all of my presentation. Thank you so much.
Thank you very much, Junhao. Another very interesting presentation. I'm sure the panel will have a couple of questions. So thank you both, Lina and Junhao. So before I hand over to Ram, I would like to introduce our expert panel today. We have Sean Osborne, who is a AASB board member and the Director of Accounting Policy and Legislation in the New South Wales Treasury, where he leads the development of accounting policies and provisions of technical guidance and advice across the New South Wales public sector. And prior to joining New South Wales Treasury, Sean has had over 25 years of accounting experience in the private sector in Australia and the UK. James Price is Managing Director at Experience Matters and at the Chair of the Data Leaders, and he has authored peer-reviewed articles and books, including information asset management. James is also the co-lead of a global research project on the impacts of that data, on impacts that data and information management practices. Finally, we have Michael van Houten, who is a partner at Ernst & Young's professional practice IFRS team after spending, who is now a partner at the IFRS team after spending 17 years in the assurance, advisory and audit teams. So Michael provides IFRS accounting support on a wide range of topics across different sectors, including leases, presentation and disclosure matters, intangible assets and business combination. So thank you very much. It's great to have you here and I look forward to the discussion. Ram, over to you.
Thanks, Sabine. Quite an interesting topic to be discussing this lovely afternoon. Just to set the scene, maybe if I could go to the panel and ask a question around data. Setting aside the accounting considerations of data and the broader question of intangibles, what are your thoughts on organizations considering data as an asset more broadly? So we're not talking accounting here, but the broad concept of data and how organizations see value in that data that they hold and potentially calling it an asset. So maybe, James, if I could turn to you first with that broad question.
Look, certainly. Thanks, Ram. Look, I'm actually an economist by profession. And as economists, we think about the factors or the means of production. And the Economist magazine wrote an article about how China is viewing data, information and knowledge, and they're doing it as one of the 4 fundamental factors of production. We see this in business all the time, in the sense that organizations only have 4 sets of resources. So coming down to the microeconomic area now, that they have their annual budget, they have their good people, they have their physical assets, their property, their computing infrastructure, their desks and so on, and they have their data, information and knowledge. Those 4 asset classes can be categorized, they can be classified, they can be stored, they can be proactively deployed in order to conduct the activities and the processes of the organization. And indeed, if you look at it from the perspective of what would happen if you removed those assets, if you took away data or data, information and knowledge, what would that do to every business decision that gets made, every business activity that is conducted, every process that happens? The answer is the organization would grind to a halt. And yet it's fascinating to me that boards and directors still do not view data, information and knowledge and indeed govern and manage it with the same level of diligence and rigor as that with which they manage their money. So we view data as an absolutely critical asset, as the lifeblood of an organization, and yet we are still not seeing boards and directors asking to see the information statements. We're still not seeing them govern and manage the asset the way they manage their money. So there is a gap between the rhetoric and the reality. Does that answer the question, Ram?
Yes, it does. And I probably have a follow-up question, and maybe I'll turn to a couple of the other panelists, maybe Michael and Sean. And to what James has just said, data permeates an organization. So it's pretty much in everything that an organization does. And I know, James, you talked about 4 categories of data assets. And Michael, if I could just turn to you perhaps, and maybe you can share some of your experiences around how an organization should see data as a source of value, as an asset.
It is an interesting question, Ram, and I think in this emerging environment with AI and the like, we're increasingly talking about the importance of information and quality information. We're looking at large language models and the quality of the output, and them as a resource is only as good as the data that is within that. I think what I find, I know you said to avoid the accounting, Ram, but from my perspective, that's hard to do so. But I find it interesting. There is, I guess, no question of the value and the importance of data, both as an input and the importance to financial reporting. But beyond that, I think there's a wide range of views around, well, what is data? Why is it valuable? How do we capture the value associated with that? And then that drives some of the follow-on accounting questions that follow from there.
We'll get to the accounting question, Michael. Sean, do you want to share some of your views from a public sector perspective?
Sorry, Ram, just finding the audio button on Zoom. I'm not that used to Zoom. Yeah, look, I'm happy to. Look, coming from the public sector and having a similar set of responsibilities, I guess, to Michael, I can't help but think about the accounting implications. But I'll do my best to put that aside, because I think, when I come from the public sector perspective, there's 2 things I think about. One is we have a lot of data, and I'm aware that across the public sector, people are looking at that and they're identifying it. They're not necessarily linking that with accounting. So what are they doing, and why would we want to understand that? I think there is some data that we hold where financial value is important, because we often do monetize things. We often enter into public to private partnerships where financial value is derived from those assets. But more often than not, we hold that data to provide public services. It's a different purpose. So I think one of the things we talk about a lot in the public sector is accountability. So I think one of the things that would be useful in identifying these assets, understanding what they are, understanding what they're used for, perhaps what they cost, maybe something about their value, helps support decisions around the allocation of resources that are actually, citizen resources. So what do we do to protect those assets? And what information do we need to justify investment in those assets, maintaining those assets and protecting those assets? So I think, it comes down to looking at similar things, but we perhaps use the information for slightly different purposes in the public sector context.
Yeah, I think in a sense it's more internally focused to see how the data fits into how a public sector organization goes about doing what it's expected to do. Maybe we can turn to that accounting question now, Michael, and seek your views on the accounting angle of data, and particularly seeing data as a part of internally generated assets or broader intangible assets. What would an investor's view be here? Would an investor want to see data as part of a company's balance sheet, or maybe elsewhere? I mean, maybe the information doesn't have to be on a balance sheet; it could be elsewhere. And we're not just necessarily just focusing on data. We could look at the broader category of intangible assets here as well. But let's just stick to the point of data at the moment as part of intangible assets. Michael, how do you see investors perceiving the value of seeing that information on balance sheets or elsewhere?
Yeah, I think that's a difficult one to answer, because obviously investors and users are a very wide group. But I think the AASB's research supporting their research program project is interesting, and that highlights almost unanimous view that financial statements at the moment are inadequate for describing or measuring, providing information around intangible assets. There's more mixed views on how that might be addressed, but that says that there is a need or a desire for further or better quality financial reporting information. I'm a little bit hesitant around that as well. In my experience with preparers and indirectly hearing the views of their users, quite often we see efforts to add back information around intangibles. So take a business combination where we might have recognised some significant value for brand, customer assets and the like. Often you see efforts to add back and provide non-IFRS information to get rid of some of the noise of the intangible asset accounting. So for me, I'm sort of getting mixed signals between, I guess, a desire to close the gap and to provide better quality information, but then some practical observations that there's actually efforts to add back and disregard some of that accounting noise, which is subjective and non-cash.
Thanks, Michael. James, do you want to add to that?
Yeah, Ram. Look, Michael makes a very good point. When we've been looking at the research that we're doing, to which Sabine referred, we're looking both at the value of the asset, and there's a number of ways of being able to put a value on data, and that is you might be able to sell it, in which case is a market value. You might be able to look at the cost of the data. You might be able to look at the replacement value of the data. You might be able to look at the potential revenue stream generated by the data. You might be able to look at societal value or whatever, and that's one component of it. But there are three others. There's the risk associated with your data, and that's not just cyber. That's things like disaster recovery and business continuity. It's about discovery and litigation. It's about reputation and social license to operate. The third, so we've got data, we've got risk, we've got cost. What does it cost to manage your data? Now, when I ask chief financial officers how much it costs to manage their data, they say, James, that's easy. Hardware, software, maintenance, support, upgrades, telecommunications, and IT staff salaries. And I say, well, you know that's rubbish, and I know that's rubbish, so what does it cost? They've got no idea. But the last one, and the really interesting one for us, I think, is what can it do from a productivity perspective, or an impact that data and its management has on a business. For instance, is customer satisfaction important to an organisation? Yes, it is, right? And your data, information and knowledge have a significant impact on that. Is the reduction of staff frustration important? Is good decision making important? The answer to all of these questions is, of course, yes. And yet we don't account for that. We don't even present to the executive team a list of the things that are important to the business. So if you talk to a school, as an example, they'll say the information about a student, particularly their medical history, and if they have a mental health issue or whatever, is incredibly sensitive. So they will view that as a really important consideration in their business. So I think, Ram, there is the opportunity to put a value on data, but there are other considerations as well. And once you do recognise the value, so for instance, we did a piece of work for a very large wine company, and they sold some data that they would normally give away to research institutions. An ag tech company said, "Listen, we'd like access to your data. What are you going to do with it? We're going to sell it." Well, in that case, we're going to sell it to you. So we worked with not with the vendor, not with the wine company, but the purchaser, and came up with a number that was acceptable to both parties. And this organisation drove a 1,200% return on investment over 3 years. It's an organisation that wants to break even in 2 years, and they broke even in 13 weeks. So the data had an extraordinary return on investment. And similarly, a part of that business said to us, "Well, we'd like to improve our practices." So we helped them with some simple tools that helped them understand what to call stuff and where to put stuff so they could find it again. And then they ran a little benefits realisation program over that, and these guys broke even in 8 weeks. They drove a $10,800 per person per year productivity improvement. So I think, Ram, there are really tangible ways we can start to look at not only the value of the data, but the value of the benefit that comes out of it.
Excellent. So I think there's a two-step process here. The company firstly has to recognize the value of the data it holds internally before even considering that external disclosure point, which is what we want to talk about here in this particular question. But maybe if I can just extend that question a little bit and look at the independent audit or the verification of the information that's in financial statements. And Michael, I'm going to come back to you on this. And it's also a question from the audience as well around the objective way in which you can quantify data that becomes the lens itself to being auditable. I know that can be a challenge, but do you want to share some insights on how that might be an issue?
Sure. I think when it comes to auditability, we're really looking at, well, are there clear rules and guidelines for what we recognise, how we recognise, and how we value those assets so that they are understood and comparable between organisations. I think from my perspective, the challenge I have with just getting my head around the value of data is, unless you've got a situation like James just described where you can transact in data itself, so often data is just an integral part to running the business. So it's such an important input into ultimately being able to sell and generate revenues or other economic benefits. But together with the data, that requires leveraging my brand, that requires use of my IT systems, it uses my organised workforce and other aspects of goodwill. So in establishing, well, what is the value of the data? How does that compare with all the other aspects of my unrecognised goodwill? So I think the key challenge is having a methodology or a set of frameworks that are well understood both conceptually and can be consistently applied. Because I think the hesitation comes from, well, what degree of subjectivity is there amongst preparers? Now, do I understand it? Is it just rubbery noise that I'm going to ignore? Or is it something that I can tangibly understand and compare and assess the value of that data?
Thank you. And would any other panelists wish to contribute on the auditing side of the question? Sean or yes, Sean?
Yeah, look, only to the extent, and I know there's been a question from a member of the audience that Michael's volunteered to answer, but only to the extent that, I think, and I hate to be a boring accountant, but at some point, if we're going to recognize these assets, having criteria around recognition as well as measurement is going to be important. And I think whether it's in my space, which is public sector assets or non-public sector assets, I can see the delineation between at least 3 different types of data assets. And there's a question as to which of those should be recognized, and therefore what is the criteria for those. And that's not me as an expert in data, that's just me as an accountant thinking about the fact that I've got some data assets that I'm using to provide services, some which are using to provide services on a sort of semi-commercial basis that in theory could be commercialized, and some that are, for example, being developed perhaps by universities that are purely commercial. So where do you draw the line for that recognition? So I think that needs to be clear, because the standards are designed to be auditable standards. And if I then look back to when I was in the private sector, even for things like software, if it's not your business, software is not your business, the evidential challenges around demonstrating even compliance with IAS 38 is actually quite difficult. It's an awful amount of a lot of data you've got to provide to auditors. And I wasn't surprised in that last presentation that one of the reasons for not perhaps not applying that pilot accounting approach was the fact that people were concerned about the evidence to support what they would recognize on the balance sheet.
And I think one of the points that was earlier made was the quality of the data as well, because the data can be of a very good quality or may not be of such a good quality. And then how do you measure something of varying degrees of quality? If you just if I could just stay with you, Sean, and consider that recognition and measurement issue a little bit more. As accountants, we appreciate that, in business combinations, we can potentially recognize value or measure intangible assets. And that could include data. It could include customer databases. It could include other things that are within that broad category of intangibles. So if you can do it in a business combination scenario, why can't you do it otherwise, I suppose is the question. Do you want to add anything to that before I go to the other panelists?
I can try. I'm not sure I've thought about that before, but I guess, what I have thought about is that in a business combination, you essentially, you pay a total cost for a business, and allocate it to identifiable intangibles. So you do have, subject to the allocation process, you have a good piece of evidence to drive what was, if you like, cost, but something that was a fair value, a market value at that point in time. Whereas when you internally generate assets, you have, well, you've got the limitations that are in IAS 38 already, but even if you remove those, you've still got this question of which of those costs do you recognize, and then whether that total cost is actually the same thing as when you did a business combination. I don't think it is. I think it's a different number. So you've got the issue that you would have 2 similar intangibles that were priced at cost at a different point in time. And I know there's a question which might flow, if I could probably sort of flow that into one of the questions I've seen from the
panel
members.
It's the question on state land registry.
Yeah.
Value.
So, somebody asked a brilliant question, and thankfully I had thought about this before, although I did have to quickly Google what the dollar amount was. So, several states have entered into arrangements. I'm not going to say privatize, although that's what the headline said. They've entered into public-private partnership service concessions with the private sector to run their land and property registries. And I won't talk specifically about New South Wales, but I think the headlines will tell you that it was the deal was $2.6 billion. And at that point in time, you've got an accounting standard, AASB 1059 on service concessions that says, hey, you may not have recognized this intangible before, but now you do. The same standard also says that you should recognize service concession assets at replacement cost under the valuation methodology. So that probably isn't the same number as the 2.6 that you just received. So yeah, that was a really good question that I think goes to the fundamental issue about different types of intangibles arising in different circumstances. And yeah, maybe we should recognize them, but is the information or the value that we assign to them necessarily comparable?
And maybe that's where some of the work the AASB is doing comes in. And Michael, I know you've had a look into some of that work that the AASB is doing. Is there anything there you can share that contributes to this question of measurement?
Yeah, there is a couple of things. So I think Sean covered nicely why we do recognise some more intangibles in a business combination. There are a number of challenges when we look at the process to internally generate intangibles. And I think if you think about data, it's not a single asset. So it's very different to another asset like a truck, obviously, or even a software license where the asset is easy to get your head around what it is. Data is the collection of a whole lot of things which continues to be managed, updated, and it evolves. So yeah, the first challenge is, well, when we talk about a data asset, what is the asset? Is it your personal data around, or is it the data for everyone collectively? And then how do we manage changes in that? So do we impair that, or what is the amortization period for that, given this ever evolving nature of the asset that goes with that? And I think the other challenge as well is a lot of the reasons for the current prohibition on recognising internally generated intangibles is it's just hard to identify the costs. So if you're not acquiring information in a direct transaction, data arises from a number of different sources through your own operations, through your own research and some other things. So trying to differentiate, well, what portion of the cost represents the data asset versus creating other unrecognised intangibles, or just running the business as it is, as in today. So there's some of the challenges that go to, I guess, identifying, recognising, but ultimately to the valuation also.
Thanks, Michael. James, maybe if I can come to you on this same question. I know you talked about how organizations should internally recognize what data they hold and report it upwards or within the organization. When you're reporting externally, both Michael and Sean have sort of signposted some of the challenges around reliably measuring that value and recognizing it in the financials. So do you have any thoughts on that external focus?
Look, the external focus is hard from a reporting perspective, as we've discussed, and I mean, I'm loving this conversation because it's already there are contradictions being thrown up already. I mean, Jun Hao said, the accounting profession is losing its relevance. Yeah, so what are we going to do about it? We can't just say, oh, it's too hard and put it in the hard basket and go back to bed. We've actually got to do something about it. If I can start, Ram, from the internal perspective, Australians have led the world in thinking about records management. In 1996, the International Standards Organisation took the Australian Records Management Standard and turned it into the international records standard, which is ISO 15489. Now, there were some pretty interesting things in the Australian approach. The first was a thing called functional classification, which is a stupid name for creating an information chart of accounts. Right? It is exactly the same as a financial chart of accounts, place for everything and everything in its place. So then the next question is, well, okay, if we're going to have place for everything and everything in its place, what are the crown jewels? Right? What are the crown jewels of the organisation as far as information is concerned? And again, the records managers back in 1996 were talking about things called vital records. Now, if you go to let's say your organisation is an oil and gas company. Well, you can go to the geophysicists and say, which seismic information is really important to you? Well, they can tell you that they do that every day. the HR department, the finance department, the logistics department, I mean, the procurement, they will all know what information they categorically need in order to be able to do their business. And Bram, if you just start with that, then at least what you have is an understanding of the information, the data, information and knowledge assets in the organisation that are valuable. You can probably apply a vulnerability rating to that as well. And as soon as you've got that, you know what information you've got to nurture and protect. So it's a hell of a good start. The other thing that we don't do, Ram, is, and again, this is internal, and I alluded to it in one of the examples I just gave, which was we don't look at the benefit that comes out of doing this stuff well. We don't measure that, and yet it can be a really simple and effective exercise. So where I want to, I'm not an accountant, so I'm not so interested in the external reporting. What I'm interested is in the internal investment, right? I want boards and chief executives and chief financial officers saying, investment in the governance and management of data, information and knowledge is a better use of my money than anything else, right? And until we start measuring that, it's really hard to do it, right? So what China's done, as we started this conversation, China has recognised that data, information and knowledge is not only has value, it is a source of international competitive advantage, right? And if China is doing that on a national scale, surely we can do it on an independent organisational scale, an enterprise scale within a firm. Does that answer the question, Ram?
Yeah, I think it does. And maybe if I stay with you, James, for a minute, this is a question that came from the audience, which I'm trying to unpack and see how I can present it to see if we can get a response on it. It's to do with recognition of aspects of human capital. We're not talking about human capital itself, but we're talking about aspects of it, because human capital arguably is a different topic. The question is around valuing and recognizing data for what an individual brings into an organization. So I suppose an individual comes with experience, knowledge, qualifications, etc., which all comes along with some data that they bring along to the business that they share with the business and make the business more valuable as a result. This is getting into the weeds here a little bit, but the question is around, can that data provided to the firm originally be valued? I suppose is what the question is asking. And what are the privacy implications and infringement on individual persons' confidentiality, etc., was a second part to that question. So there are two parts to it. One is, can the data provided by an individual to an organization be valued? Second part to that is, what about confidentiality, privacy, etc.?
Right. So the first thing I think that that we try to recognise is that if you are looking at the factors of production, as we were talking about, as far as how the Chinese are viewing this, then what you're doing is you're putting all data, information, and knowledge into the same bucket, and you are governing and managing it as an asset that you can categorize, you can classify and categorize and consciously deploy, right? You can't do that with some of the other intangible assets like goodwill or relationship capital or brand awareness or whatever. You can't actively deploy it in the conduct of your business. Now, the reason why we've taken that view is that I've had archivists fighting with records managers, fighting with librarians, fighting with historians. And I've said, stop. We are not the enemy. We've actually got to get our hands around this asset, the value of the asset, the risk of the asset, the cost of the asset, and the benefit that it drives. So, knowledge is just as tough a question as any other of those components. But again, I think we've got to be as soon as we start trying to put unless we can sell it or have a transaction around the thing, it's going to be a fairly nebulous discussion. So Again, I like to provide real examples. There was an Australian manufacturer, and the chair of the board asked the chief executive at a board meeting, "What is your greatest business risk, or what is your greatest business asset?" And the chief executive said, "A bloke called Lou Jones." And so the chair said, "Is that right? Well, in that case, I want you to double Lou's salary starting at 9 a.m. on Monday morning." And the chief executive started to kick up because it meant to say that Lou was being paid more than the chief executive was. And the chair said, "Mate, I can get another one of you tomorrow. I can't get another Lou Jones." So with that very conversation, the chair was putting an arbitrary value on Lou and the value that, or the risk that Lou represented for the organisation, right? And that was the increase in salary. Now, do we have a methodology for evaluating why Lou was so valuable? No, of course we don't. Well, not yet. But yet it was recognised. There was a gut feel recognition that this particular individual was absolutely pivotal to the success of the organisation. So, look, I think we can do it kind of anecdotally, and I think we can do it if you look. I mean, if I had a question, I had a discussion with one of my lawyer mates a little while ago, and I said we should put you guys should put KPIs around lawyers and the legal services they provide. He said, "We can't do that." I said, "Can you describe for me what a good lawyer looks like and what a bad lawyer looks like?" He said, "Yeah, of course I can." I said, "Well, there's your starting point. Away we go." So Ram, I think it's really hard to put, and in answer to the question, which is a great question, I think it's really hard to put a value on knowledge in a hard purely financial sense. But then, looking at it the other way, what's the cost or the risk to an organisation of having a poisonous employee, or somebody who is going to write a report worth $440,000 that has been generated by artificial intelligence and nobody's checked it, right? So I think there are ways in which we can think about the value of that employee and the knowledge that he or she has, but I think it's pretty tough to put a hard number on it.
Thanks, James. That's a good response. I'm going to go to the researchers here. There's a question from the audience that is directed to the researchers, and the question is, what were the main measurement bases disclosed in the Chinese company financial statements, and were these identified as internal valuations or valuations from external experts? Lena, would you like to take that question first, and then I'll turn to Junhao?
Yeah, of course. Thank you. So actually, based on my presentation and also reading companies' annual report, so companies do not really disclose lots of information on that. And I think the main reason is because as long as it's not significant, then you don't have to disclose all the details. So actually, it's also a puzzle for us. We actually talked to one company and asked them how they really do all those kind of valuation. And so actually, there is a new industry on data valuation. So there is an association. Once data asset provision has been published, the association has been established as well to guide like how you should evaluate on data. And so if I use a water company as an example, because we did one interview with a water utility company and to ask how they come up with their data assets, what they said is, for example, for employee who work on collection of meter information from each household. And before it's a salary expense, but now they can capitalize it because eventually it becomes their assets, and they have those kind of information. For example, they know the customer, like how much water they use, and they kind of can make their billing much more easier and analyze the pattern of usage of water. So all those kind of information can be capitalized as assets. Yeah.
Thanks, Lena. And Junhao, would you like to add to that?
Yes, sure. So I think for this question, we did a site visit to this kind of like professional association last year. So it's actually, they are affiliated with People's Daily, the national news media of China. So it's called People's Data. So they are a professional body. Like they kind of like give out certificates for firms, corporate, for their corporate data resources. They kind of certify, okay, this is the data you own, or you only have the usership to the data, and they will do some valuation over the data, say, okay, this is the value we think should be consistent with the guidance from the interim provisions. So that's how it works. And the companies will pay like maybe 100 to 150K Australian dollars equivalently to that agent to get that certificate. And they need to renew the certificate every 2 or 3 years, depending on how it is structured. So yeah, that's basically how it works. And most of the time in the auditing process, for example, if they have the certificate from that association, then they will be able to like go through the auditor, because the auditor will say, okay, well, I will sign off as long as you got the certificate from that association. So that's how it works in China right now. But for public firms, as Lina just mentioned, because now all of them have substantial amount of data asset on their financial statements. So just very few firms, they have a substantial material amount of data asset, they have done this. But for some of the local government financing facilities, so these firms, they are not listed. They're just like, the firms affiliated with local governments. They are doing this intensively to kind of capitalize their public data, and they use the certificate from that agent. Yeah. That's what I have. Yeah, thanks.
Thank you. Thank you for that, Junhao. I think what we've heard so far, both from the researchers and from the panelists, is that there are significant challenges in putting a dollar value, a currency value on data. And so we need to, if you want to cross that bridge and actually put things on the balance sheet, that's one of the big challenges to overcome. What about looking at it slightly tangentially? And this is actually a question from the audience as well. So if valuation is too challenging, how can we present the value that we hold in data differently? And we know that sustainability reporting is taking hold, with climate reporting being the first first thing of the mark. So I guess the question is, can we actually look at another way of reporting corporate value that is held in data, not necessarily through financial numbers? And Michael, would you like to take that one first?
Yeah, sure. This was going through my mind as James was chatting earlier, because he does give that fair challenge. It's just because it's hard, it doesn't mean that we don't have the need to challenge this more broadly, and that's why we do have the AASB's research project. But for me, as James was talking, what I personally want to understand, rather than the dollar figure, is what data is important and why is it important in the entity's business model. But also just sort of thinking around even ASIC's regulatory guide on the OFR, like that does give some framework for quality disclosure on business model, how an entity makes money and the like. So I'd love to see something like that enhanced and maybe enforced a little bit more strictly, so we can get a better handle on that data. The skeptic in me says, though, that if it's not mandatory and in the financial statements, the quality of that is hard to enforce. And we've seen that OFRs generally do a pretty boilerplate job of, or a cursory job of, explaining those inputs, and we constantly get the challenge, well, providing more information becomes commercially sensitive. Data is so important to me, I don't want to tell anyone else how I'm using it and how important it is in the organisation, because it is a competitive advantage. So that'd be the one that jumps to me immediately. Just better description of the business model, data as an input into the value the entity creates, and how the entity then drives value through using and utilising that data.
Thanks, Michael. And maybe, Sean, if I could turn to you on that same question. I know in the public sector, non-financial reporting is a big thing, especially when you're looking at service performance reporting and the likes. So would you like to share your thoughts on how we could perhaps disclose some information around the value that public sector organizations hold in data, not necessarily through the financial statements, but other means?
Yeah, I can. I think, and I think some of the things I've been thinking about really apply to as much to the private sector as they do to the public sector. I think, the current sustainability and climate disclosures talk about risks and opportunities. And I guess if I'm a stakeholder, whether I'm a shareholder or a citizen in an entity that cannot value these assets, but nonetheless those assets are, as Michael has said, integral to my business model, then what are the risks to those assets? Can someone explain those risks to me if they're not going to put a number on it? And can they explain what I'm going to do about what I'm doing about those risks? How am I protecting those assets? What am I doing to maintain the data sets to the extent they need maintaining? If I don't have a value and a useful life, what sort of things would kill that data set for me? So I think that sort of information really applies to both sectors, not just the public sector. It might be that in the public sector, the stakeholder group is broader, and therefore they may focus more on certain aspects. So they may focus more on the protection of confidentiality and the impact of the risks to those data sets impacting service provision as opposed to dividends. But fundamentally, I think there is a set of information that everybody would like to know beyond the numbers.
Thanks, Sean. And if I could stay with you for a minute, you mentioned the state land registry point earlier as a data asset that has value in the public sector. Can you think of other things in the public sector that could be considered of high value, which may or may not be disclosed, by the way, externally for various reasons?
I can, yes. I mean, there's a degree of sensitivity, of course, because what happens with land registry is that there's a political decision taken to enter into a commercial arrangement with something, and another government on a different day might decide that's not their policy. So there's a degree of sensitivity. But of course, if you think about it, any data set, so I'm being a little bit careful here what I say, any data set that a government holds that is directly linked to a revenue stream, you can think of all the things that you might go into Service New South Wales or MyGov with. Any of those, in theory, could at some point in the future, possibly subject, or certainly subject to legislative change and government policy change, be monetised. So I am purposely being a little bit careful here, but it's certainly, I think what you say is true. There would be data sets that in theory, subject to political will, could be monetised, and many, if not most of those, would not be recognised. Having said that, we do have some data sets that are recognised. So if you look at the financial statements of museums and state libraries, etc., you will see, and the Royal Botanical Gardens, you will see that there are data sets of archives that people can use that do actually have a value placed on them.
Yeah, no, absolutely. You're right. Thank you for that. So there's data that can be recognized and displayed, and there's others which is much harder to do. Think ATO, for example. I mean, they hold significant amounts of data on taxpayers, but that's very confidential, very sensitive information, of course.
It is, and I think that's why throughout today's session, I've been thinking about recognition and control. And I know, I think James is absolutely right when he challenges the accountants and says, well, if these things are important to people and they're not on balance sheets, and you guys are the professionals of the balance sheets, you might be less relevant tomorrow if you don't deal with it. So I'd certainly think it's a topic that needs to be dealt with. But, I've just been starting to think about, well, which of these would you recognise? And I do think there's as I said, in the public sector, there'll be things that are developed for commercialisation, things that are not developed for commercialisation but could be commercialised, and things that could never be commercialised. And I just don't know where the barrier is for those things. When you look at those assets that are recognised, such as the Royal Botanical Gardens archives and the state archives, etc., what is interesting is that the public sector, sorry, I think they're at cost. Sorry, they're at cost. They're held at cost. Should clarify that. But when you look at other assets that those organisations held, such as the physical books, the physical plants, the paintings in the art gallery, etc., and then you look at things like libraries themselves, courthouses, the public sector actually does have a good track record for those physical assets of valuing things that look quite difficult to value, for which there is possibly not really a market. So I do think, you know, there's a whole bunch of things here we can think about, and there is a route through. It's just I'm not sure I've totally worked out in my head what that route is yet.
Thank you, Sean. And we've almost run out of time, but 10 seconds, James, any final comments before I ask Michael the same question?
Yeah, look, I mean, Sean's touched on some terrific things, and I mentioned that we're looking at risk, cost, value, and benefit. To take an area that perhaps doesn't have a lot of revenue associated with it, but has an enormous amount of cost, might be an area like biosecurity. So what would the advent of rabies do to Australia, or any other really significant disease coming into the country? What is it worth for us to manage our information well, so that we can help prevent that from happening in the first place, or addressing it once an outbreak occurs, like fire ants or the varroa mite for bees and whatever. So I think there's a lot of different ways in which we can put a value on data, information, and knowledge, and I think we just have to be creative about it.
Thank you for that, James. And Michael, any final words?
Yeah, thank you. I think for me, it's I'm reflecting maybe a little bit, focused too much on the challenges, and I think hearing all of the benefits and the role of financial reporting, I am certainly interested to follow the AASB's project. I think we do have a need for better information around intangibles. We've got many new intangibles with emerging technologies and new use cases. So it's certainly a project I'll continue to follow with interest, and as a profession, hopefully seeing us sort of grapple with that challenge as best we can.
Thank you, Michael. There's quite a lot of useful information that all of you have shared. So I know we've run out of time, so I'm going to pass back to Sabina at this stage. Thank you.
Thank you very much, Ram, and thank you everybody else, the researchers, Lena and Junhao, and of course the panelists, James, Sean and Michael. It was a fantastic, very insightful discussion. We've uncovered many different aspects that the standard setters, and both in accounting and assurance, might have to take into account when they will be looking into data assets. We've heard about data categorization, and then how, what is data? Are there different categories? Do different categories require different measurement methods, or should there be disclosures rather if for those that cannot be measured and recognized? And then, of course, the very different aspects in the public sector, where we have a lot of considerations that are political or privacy related, ownership of data, etc. So a lot for the standard setters to think about. So I'm sure that will be keeping us busy for a little while yet. And yeah, thank you again, everybody, also the audience, for the very great questions. And please do follow us on LinkedIn and our newsletter if you haven't subscribed yet. And otherwise, I will see you in the next dialogue series. Thank you very much.
Thank you.
Thanks, Sabine.